Okay, so in handout 17, we learn how to do pro forma financial projections. What are these pro forma financial projections? All they are projections of financial statements into future accounting periods, and we want to create them for two reasons. Generally, predicting an entity's future financial performance. Once we project forward these financial statements, we can answer a lot of questions, and we can, in particular, perform ratio analysis of future period statements and get a good feel for how the company might be looking financially in the future. And need two is very central in finance. How do we get our beautiful free cash flows when we're valuing an entity? Well, remember we had equations that showed what those were. That included the net income, the changes in the debt, the changes in the working capital. So to get these future free cash flows, we really need to project our financial statements into the future. So our general framework for creating these is we always start at t equals 0 now, and we set things up so that assets equal liabilities plus equity is true. And then to project to our future period, t equal 1, we're going to use quote unquote reasonable methods to estimate the value of each account at the end of the period t equal 1, and we still want to have assets equal liabilities plus equity. So what do I mean by reasonable methods? Well, for now, this is not always true when we get more advanced, but for now, we're going to assume the future sort of looks like the past. Company's been growing by 10%. It will continue to something like that. It's not jumping into a new market, no new products. It's not cutting off a product line, and that its industry is not being disrupted, etc. Okay. So then to compute a future value for account, wherever possible, we're going to use an accounting formula or CEO's or CFO's directive. So formula we've looked at, for example, we've kind of beaten this to death. The interest paid in period 1 is equal to the debt at the beginning of the period. That would come from the prior period's balance sheet times the interest rate for this firm. A CEO's directive could be something like hold the debt level constant for the next 2 years. That's what the board wants. That's what the CFO wants. So for anything where we don't have an accounting formula or a directive, we're just going to do something like this. If we're looking at account X, like something like COGS, say, cost of goods sold, we say that the ratio of the value of the COGS account to the sales in that period is equal to the ratio of the COGS in the prior period to sales in the prior period. So in words, we could say something like accounts receivable or COGS, whichever one we're looking at, has been running at 10% of sales. So we're just going to assume that's going to be true in future periods. If accounts receivable has been 10% of sales historically, which we have here, it's going to be true in the future. Same thing with COGS. If COGS has historically been 10% of sales, we're going to say same thing is true in the future. And as we saw in the lecture, that's actually a pretty good assumption. So that gets us to our little recipe or algorithm for doing this. So to project things forward, we need to get our historical balance sheets, income statements, plus our depreciation, capex, and equity roll forward equations. We'll make reasonable assumptions about the future, and these, for us, these are given by CFO or etc. So I would definitely not expect you to have to make the reasonable assumptions about the future. I would expect that the CFO or someone else would be giving you these. And then we just, with all the stuff the CFO has given us and anything that hasn't come from the CFO, we know we have to project as a constant percent of sales. We go ahead and project everything we can using reasonable methods. And then for anything we're trying to solve for, we use our accounting equations, assets equals liabilities plus equity, or our equity roll forward equation to solve for any final thing that we didn't get from up here. And then if we're projecting for more than 1 year, we just repeat the same thing with year 2. Go 1 year at a time and everything will work out fine. So usually we do these pro formas when the CFO or the board or somebody has a big question they want to answer. So for example, the CFO says, I'm working on this strategy with the CEO. If we follow this strategy, what will be our cash position 2 years from now? And Another thing that's very common is the board could say to the CFO, given this current strategy, it's time to start issuing dividends. What's the biggest dividend we can issue for the next 2 years? So those would be examples of big questions. And when we have a big question on the table, you want to project everything else. You want to project everything but cash, and then use these two equations at the very end to help us solve for cash. Okay, don't forget, seasonal companies have to be projected quarterly or monthly. Heads up that on the final, I won't ask you to do a seasonal company. And non-seasonal companies, we can just project yearly, and that's what we'll be doing on the final. And then next up here, I went into Sahali snacks. So for the Sahali snacks example, I'm going to jump right to page 37 and talk about setting up projections. So when you're doing pro forma projections, you're always going to have four things to think about: two roll forward equations and two financial statements. So the first roll forward equation, and this is generally in most circumstances what you should try and project first. The first thing is our PPE roll forward equation that says net PPE beginning of period minus where plus additions to PPE equals what we have at the end of the period. And one way or another, you're always going to know 3 out of the 4 things, and you just have to solve for the fourth one. And in the real world, of course, you work with the CFO to make sure that's true. So we're definitely always going to know the beginning of period net PPE, because that comes from the most recent balance sheet. And then the where, actually, the CFO should always be able to provide you with the where from the weighted average depreciation of everything in the firm, unless things are changing a lot. So then you're either going to know the target CapEx, or you're going to want to know the target level of net PPE that the firm wants to wind up at. So in either case, you just solve for, you put in the 3 things you do know, you solve for the fourth thing that you don't know. And in most cases, next up, what you want to project is the income statement. So you've got to get from the CFO no ifs, ands, or buts about it. What's her projection for sales growth for the next year, the next 2 years, if you're doing 2 years, etc. COGS is something that always goes as percent of sales. Depreciation comes from the roll forward equation up above that you've already projected. And things like SGA, we're just going to follow our rule. If we don't have an formula, an algebraic formula from accounting or a dictate from the CFO or the board, we're just going to say it projects as constant percent of sales. And we do not typically have something from the CFO or the board on that. Interest, we always have a formula for. It's always the interest rate times the beginning of period debt. That's the pre-tax interest rate there. And same thing with tax. As we know from financial accounting, a good estimate of how much tax is going to be paid is earnings before tax times the tax rate. And next up, depending on what you're searching for, you're going to project next either the equity roll forward equation or the balance sheet. So in the Sahali example, we're solving for sales. So we want to go ahead and do our equity roll forward equation first. So we always know equity beginning of period comes from the prior balance sheet. And then we've got our net income because we just projected the income statement. So we know that dividends are going to be from the board or the CFO. Either we're not issuing dividends or we have a policy on payout ratio or something like that. And similarly with paid in capital, there with Sahali, the policy was, even though they had a capital raise in the most recent, a buyback in the most recent year, their policy is that they're not going to have any buybacks or share issuance in the next year. So we've got with our roll forward equation, as usual, we know everything but one thing, and we solve for that one thing. So in Sahali's case, we knew everything but the equity at the end of the period. This is a fundamental accounting equation, so this is true. It's got to be true. So we know the equity at the end of 20x0 has to be 80. And in Sahali's case, we go ahead and put that on the balance sheet, and everything else on the balance sheet except for cash we use by saying, nothing special from the CFO, no accounting equation, so that goes as percent of sales, et cetera, et cetera, et cetera. We get to PPE net. We know that comes from the roll forward equation, so we take it from there. These guys are all percent of sales. And then the firm did give us a rule for how debt is going to project forward. We plug that in. And now we know everything on this balance sheet except for the cash. And we just use the magic of algebra to solve for the cash. So that's the way that it's always going to work, except what if, for example, instead of solving for cash, the board and the CFO said, we want the cash to be at this level, we want the debt to be at this level, et cetera, et cetera. So what in that case is the share issuance that we need to make everything balance, make sure we have enough cash, our balance sheet looks good, all of that stuff. So in that case, we would know everything we need to know to project out the balance sheet, and we'd compute the equity for the end of the year from the balance sheet. And the last thing we would do would be to do our equity roll forward equation. Now we would know this from the balance sheet. We'd know this from the prior balance sheet. We'd know the net income from projecting our income statement. And the board would say something like no dividends, and we would solve for the capital raise. Okay, so one way or another, the last two things that you're going to do are going to be the equity roll forward equation and the balance sheet. And if you're solving for something on the balance sheet, do the equity roll forward equation first, and that's going to give you end of period equity for the balance sheet. If we're solving for something on the equity roll forward equation, which will either be dividends or paid in capital, project that balance sheet first, and that's going to give you your end of period equity, and you just plug it in here and solve for the one thing that you don't know. Okay, so that's about it, and I'll look forward to catching up with you again soon.